Hello. The subject of my keynote today is corporate disclosure of emerging technologies. There has been quite a bit of literature on the voluntary disclosures of emerging technologies in annual reports, in quarterly reports, and in irregular filings. These voluntary disclosures have increased in corporate filings. In fact, to the extent that some accounting experts argue that financial statements, such as balance sheets, income statements, and so on, are slowly losing their relevance to investors, because most investors look for price-relevant information in irregular disclosures, in voluntary disclosures. In other words, they would read between the lines, so to speak. So there has been quite a massive literature in recent years on how to measure these voluntary disclosures, how to quantify them, and how to examine their financial impacts. In particular, there have been some studies which look at the 8K form in US corporate filings. So the 8K form is quite a flexible form, which is used for many purposes. But typically, companies use the 8K form to disclose material changes, which are price relevant. But happen not at regular intervals. So, for example, this could be adoption of a new technology or investment in an emerging technology or a patent. And in the Form 8K, there is an item called item 7.01, which relates to fair disclosure regulation. And sometimes companies use these technologies, use this form and this item to disclose hype technologies. So in particular, some of these papers, for example, this one, which was published in Management Science, showed that during the blockchain mania at the end of 2017, many companies disclosed the word blockchain, mentioned the word blockchain in their disclosures, and this led to a price bubble. So in other words, plenty of investor interest in these companies. And the odd thing is that many of these companies just speculatively mentioned the word blockchain. They were not really making real-world investments, but they were speculating about the potential of blockchain for their business, and even that was enough to initiate significant price changes in the short term. There have been other studies, such as this one, published in the Journal of Banking and Finance, which similarly shows a 5% market reaction to the announcement of such disclosures related to blockchain. And this is another one published in the Journal of Finance with similar findings. Now, the literature typically shows that firms disclosing, for example, blockchain-related information enjoy positive market reactions, which is abnormal, so an overreaction in the short term. But the question we ask in our paper is whether these technologies apply, whether these results apply to other technologies. And my co-authors and I, Dr. El Kalak, Dr. Gao, and Professor Shao, we together look at the classification, categorization of technology-related information, and specifically, we look at the phases of technological development. So some technologies tend to be overhyped, more overhyped than others. So we look at that specifically and then relate that to the stock price reaction. In order to do so, we use a tool called the Gartner Hype Cycle. The Gartner Hype Cycle basically puts two things together. One is the typical hype level of any new innovation, which goes through an upward and a downward cycle. And then what we call the S-curve in technology literature, which is effectively the fact that any new technology initially is slow to take off, but then accelerates in terms of adoption. But then after a point, people lose interest or the market saturates, or the marginal utility of adoption has a diminishing slope, and therefore the adoption slows down and eventually flattens or plateaus. And this is known as the S-curve. So the S-curve happens in an abstract sense when there is no emotions and no sentiment involved. But with hype, together with hype, we end up with a combined upward, downward, and slow upward again type of curve. And that's known as the Gartner Hype Cycle, because Gartner, a consultancy company, was responsible for its promotion and wide coinage in business circles. So according to the Gartner Hype Cycle, any new technology, any new emerging technology goes through these phases. At first, a new technology is triggered. Through time, expectations increase and the technology becomes more and more hyped until the hype reaches to a maximum. And then obviously after that point, we tend to have some sort of crash or slow burst or deflation of those overhyped expectations, which end up in a trough of disillusionment with the technology. But after that, most investors come to their senses. Most technology enthusiasts fall back in love with the technology, but again, but in a more rational and a calmer way. And so then we have this slope of enlightenment, which then results in a plateau of productivity. So this theoretical model was introduced in 1995, and it's a tool we use specifically to look at disclosures of emerging technologies in US companies in the past 10 years or so. So the tool or the model is widely covered in the media. This is, for example, a version of the model. And you can see different technologies plotted on different parts of this curve. And the colors indicate how long it would take for a particular technology to reach mainstream adoption. This is a 2022 version of the technology curve, or the Gartner Hype Cycle. You can see, for example, the NFT technology in 2022, last year, had already passed the peak of inflated expectations, because you probably remember that maybe about 3-4 years ago, NFT was the most overhyped technology, but now it's gone past that phase. Whereas there are plenty of other technologies which are yet to reach that phase, including, for example, different versions of artificial intelligence. Now, the technology hype cycle is actually, once you eyeball the data, quite telling for example, the 3D printing hype cycle is quite consistent with the share prices of companies which invested in 3D printing and with the Google trend of search terms related to 3D printing through time. So it's an interesting proxy which is not inconsistent with what we know about sentiment related to certain technologies. So we do look at about 10 years of data of companies which disclose 8K forms, including item 701, which has the fair disclosure items. And then we look specifically at the first time that a company discloses the adoption or investment in a new technology. And then among those technologies, we look at those which appear in the Gartner hype cycle of that particular year. So in other words, technologies which are hyped in certain ways. And then we look at them in different phases. So these are the top 20 most disclosed emerging technologies in our disclosures. And this is the geographic distribution of these disclosures over the geography of the United States. And as you probably are not surprised, there's a concentration of these disclosures in the California technology and startup space, particularly around Silicon Valley, in Texas, and in northeast of the United States, in New York and Massachusetts area. So we parse the 8K form. We look at mentions of 8K technologies in the 8K form using a bag of words approach. And what we find is that investors react positively in the short term to disclosures of hype technologies, but then there's a reversal and they underreact in the long term. And this disclosure frequency is negatively associated with market reaction, both in the short term and in the long term. So what this means is that, first of all, when a hype technology is disclosed to the markets, the investors overreact in the short term. Think about blockchain, but our paper goes further and looks at a range of other technologies. There is a reversal following that. But the point is that when a company keeps mentioning those words more than once in too many disclosures, then it loses its effect. In other words, investors stop being surprised or overreacting to it. But when the mentions are very low, 1, 2, or 3, then the market reaction tends to be higher. And the most significant market reaction occurs in the innovation trigger and peak of inflated expectations phases. So that's phase 1 and phase 2 of the Gartner hype cycle. Now, this overreaction is stronger for certain technologies such as fintech, and it's stronger when firms have lower institutional holdings, lower analyst coverage, and higher information asymmetry. It is also stronger for more surprising disclosures. So the model we use is initially the abnormal return model, CAR, which we regress on a dummy variable indicating whether a particular technology which has been disclosed in the 8K form belongs to the Gartner hype cycle list of that particular year. And then we control for the frequency of disclosures, for the number of 8Ks in that particular year, for the phase of disclosure, and for a whole range of other fixed effects, industry, year, and various other control variables. And then our dependent variable, we play with different versions of abnormal returns, including whether it's in the short term or long term, and whether it's estimated using the market model or the FOMO range or the Carhart, and so on. We control for return, firm size, return on assets, age, book to market, turnover, and several other typical control variables. So as you can see by eyeballing the data, the Gartner hype cycle sample mean has a higher short-term market reaction compared to the non-Gartner hype cycle mean. But this also comes through regressions, as you can see. In the short term, we have overreaction, as you can see, of about 2%, and in some cases 6 to 7%, depending on which specification is used. This overreaction is in the short term, depending on which window you use, whether -3 to 3 or -5 to 5. The overreaction changes, but it's always there. It's always positive and always significant. And then if we look at overreaction by phase, we can see that we have significance in phase 1 and phase 2, which is exactly what we expect to see. So we're not expecting to see overreaction by disclosure of a technology which is already past its prime. On the contrary, when companies disclose technologies which are either already at the peak of being overhyped or getting to that peak, that's when the most overreaction is triggered. In the long term, we tend to have underreaction. We tend to have reversal, in fact, of a similar magnitude. And that underreaction or reversal is concentrated again in phase 1 and 2, particularly phase 2. Now, of course, we want to make sure that we're not picking up the impact of any other announcements or any other events which have been happening close to the car window. So we remove observations where there has been an announcement of annual earnings, quarterly earnings, or any other sort of announcements, corporate announcements, firm level announcements. And our results, in fact, become stronger, as you can see. So the effect sizes are now about 4% up to 8%. For robustness, we estimate CAR using FOMO range, using Carhart. We also run placebo tests, and the results remain significant. We also control for investor sentiment, for disclosure tone and readability, for institutional investors, and for analyst following. So what we find is that most of the overreaction is concentrated in firms where there is low institutional holding. So in other words, firms which are dominated by retail investors, which is not surprising because those are the types of investors who tend to get emotionally trapped in hype technologies. The reversal, however, happens in higher institutional holding firms, which could be the type of firms where fund managers tend to dominate, or institutional investors tend to dominate, and therefore they bring down the prices. Similarly, the firms which have a lower analyst following tend to concentrate the effect of overreaction, as you can see here. We also find that our investors are more sensitive to disclosure of fintech technologies, financial technologies. So the effect sizes, when we zero in on financial technologies, tend to be higher. So from about 2% to about 5%, or from about 4% to about 5% again. The reason for this is that financial technologies tend to be abstract, typically. For example, with 3D printing, which is a tangible technology, you can already feel it, you can see its output. But with a technology like blockchain or NFT, it's quite hard to imagine or understand how it works. And therefore, because there is this opaqueness, the promise actually becomes exaggerated. So the less you understand it, the more you think it's revolutionary. And so this is what seems to be going on. The other point is, as you know, the Gartner hype cycle curve also tells us how long it might take new technologies to reach the plateau of productivity. And what we find is that those technologies where it takes shorter to reach the plateau tend to have a higher market reaction in the short term. So if we define a quick adoption dummy variable, that tends to be significant in our regression, which again makes sense, but it's the first time that it has been shown in an empirical setting. And then we look at the role of the technology environment. So companies which are actually located in non-Silicon Valley area. So somewhere in, for example, in the center of the United States where there aren't too many tech startups. So when those companies disclose hype technologies, it actually has a larger market impact, because of the surprise elements. And so that's also an interesting finding. The same thing goes for NASDAQ versus non-NASDAQ firms. Right. So to summarize, we have shown that investors react positively to disclosures of hype technologies in the short term, but then reverse in the long term. This is correlated with disclosure frequency, with the phase of disclosure, with the technology environment, with the type of technology which is disclosed, whether it's financial or non-financial, with characteristics of the firms, whether they typically have retail shareholders or institutional holders, whether they're followed by analysts or not, and so on. So thank you very much for your attention. I hope you've enjoyed this new research, and all the best.